In mid-September, the US Treasury repo rate surged to as high as 10% for some overnight loans. This is much higher than the upper band of the Fed's target of 1.75 to 2%. Now, this increased volatility in the US money market, especially the higher interest rate, the surge in the interest rate has led many to draw comparisons with the events that led to in the run-up to the global financial crisis. We think the similarities are largely superficial, and that the Fed will be able to maintain interest rates in line with its target. What's more important, or what's more pressing at this point in time, is that an inadequate response by the Fed could have significant consequences for offshore dollar liquidity, and it could tighten global financing conditions quite significantly. So why did the repo rate surge so high? Now, there are various supply side and demand side forces at play. For instance, there was a September 15 deadline for tax payments, which effectively meant that corporates were moving their cash balances from money market funds to the Treasury. In other words, the supply of cash available in the repo market was dwindling. At the same time, because the debt ceiling was lifted in July, it meant that the US Treasury could start rebuilding its cash buffer and increase debt issues. In other words, what this means is that the supply of collateral was increasing, just as the cash available for this collateral was diminishing. Since the global financial crisis, there have been various banking sector regulations which limit the ability and inclination of the banking sector to supply cash in the repo market. But the impact of these measures were not felt until recently, because we were operating in an excess reserves regime. But with the Fed normalizing its balance sheet and the supply and the availability of reserves in the banking system reducing, we are very much operating in what seems to be a scarce reserves system. And as a result, these pressures were quite evident this time around. At the same time, quite crucially, the impact from an inverted yield curve and persistent trade war-related worries have also been hurting funding conditions quite significantly. The good news is that these issues are not systemic. We expect the Fed to be successful in keeping interest rates in line with its target, either by conducting more overnight repo operations, term operations, or even instituting a standing repo facility. The Fed's recent announcement to expand its balance sheet by buying more Treasury bills will certainly help. A more powerful measure, of course, would be further interest rate cuts to add some steepness to the curve. However, we do not think that the Fed will go for more interest rate cuts in its latest meeting in October. What's crucial is that should the Fed fall behind the curve, the impact on global liquidity conditions could be quite significant. For instance, the cost of borrowing dollar offshore could rise meaningfully, and we are already seeing this. Let's take the case of the 3-month dollar LIBOR OIS spread, which is now the widest since early last year. At the same time, the 3-month dollar cross-currency basis, which is effectively the cost of hedging dollar, has also risen quite sharply, coinciding with the money market volatility in the US. Let's not forget, all these issues will start to push the dollar higher, further constraining global liquidity conditions. To summarize, the money market freeze in mid-September signals an operational issue. It does not signal systemic risks in the global financial system. We are confident that the Fed will be able to keep money market interest rates in line with its target. The failure to do so, however, will have significant spillover effects on the rest of the world and could tighten offshore dollar liquidity quite meaningfully.